One of the biggest misconceptions I hear about retirement is this: once I retire, my taxes will probably go down. Sometimes that's true, but often it's only true temporarily. Today I want to walk you through a tax window that exists right after retirement, a window that most people completely miss, and how it played a major role in the case study we started in the last video. Now here's a quick recap of the couple we're talking about. Ages 61 and 63, recently retired. No earned income, no Social Security yet, roughly $2.5 million saved, with a large portion in traditional IRAs. Now on the surface, it looked like a low income phase, but from a planning perspective, this was actually the most valuable tax planning opportunity of their retirement. Here's what most people don't realize. When you retire, your income might drop, but your tax exposure often doesn't just disappear. It just gets delayed. If you do nothing, IRAs continue to grow, required minimum distributions get larger, Social Security turns on, Medicare premiums increase, and suddenly, taxes spike later in retirement when you have less control. The mistake isn't paying taxes. The mistake is deferring taxes blindly, without a long-term plan. So I want to talk about tax rate management. One thing we focus heavily on with clients is the idea of tax rate management, not tax avoidance. The goal isn't to pay the least tax this year. The goal is to pay tax intentionally, at the right rates, at the right time, to pay less tax over the long term. And that's exactly what this early retirement window allowed us to do. Because this couple had no earned income and no Social Security yet, they were sitting in an unusually low tax bracket. We asked a simple but powerful question: how much can we intentionally pull from their IRAs and still stay in a favorable tax bracket? This is what we call filling the tax brackets. Instead of avoiding IRA withdrawals, we use them on purpose to fill low tax brackets that would likely never exist again once Social Security and RMDs begin. One area we looked at specifically for them was doing Roth conversions. That decision alone helped reduce future tax risk significantly. Another opportunity we evaluated during this early retirement window involved capital gains. And this is something most retirees misunderstand. There are actually two powerful ways to use low-income years when it comes to appreciated investments. Number one is selling at a 0% capital gains rate. In certain years, it can make sense to intentionally realize capital gains at a 0% capital gains tax rate. Many people don't realize this, but the 0% capital gains bracket is much higher than expected, often close to $100,000 of income for married couples, before even factoring in the standard deduction. So instead of avoiding gains forever, we asked, is there a year where selling appreciated investments creates flexibility without creating a tax bill? When done intentionally, this can reset cost basis, reduce future tax exposure, and create cleaner income planning later on. Now, number two is gifting appreciated stock for your giving. The second prong ties into giving, and this is where planning intersects with stewardship. If a couple is already charitably inclined, gifting appreciated stock instead of cash can make sense. By donating appreciated investments directly, they avoid capital gains tax entirely, they receive a charitable deduction, and they give in a more tax-efficient way. So instead of writing a check, they're using assets that would have created a tax liability later and redirecting them towards something meaningful. That's good planning, but it's also good stewardship. There's a principle in Scripture that's talked about in Matthew 25 and Luke 19 about being faithful with what we're given. Thoughtful giving doesn't just happen, it's planned intentionally. Now, going back to talking about being intentional with using these low tax years, one of the most common mistakes we see is retirees defaulting to taking from their taxable accounts only in these low tax years because it feels tax efficient in the current year. But that short-term thinking often leads to much higher taxes later on when the options are more limited. Good planning looks ahead, not just at the next 12 months. Now, because we manage taxes intentionally during this early window, future required minimum distribution pressure was reduced, flexibility later in retirement increased because they had different tax buckets, Roth, pre-tax, and taxable. And most importantly, this couple wasn't forced into rushed decisions later on. This tax strategy is what made the final piece possible: delaying Social Security with confidence. There's a principle in Proverbs about leaving wisely for the future. Thoughtful tax planning isn't just about today. It shapes flexibility and options years down the road for you, but maybe even future generations. Retirement tax planning doesn't end when work stops. In many ways, that's when it finally begins. In the next video, we'll walk through the Social Security decision and how coordinating it with income and tax planning changed the entire outcome. Thanks so much for watching. We hope to see you in the next video.